Want to talk about Warren Buffett and what does he look for in a company and the timeless principles behind his investments. So, what he does is he focuses on understandable businesses. He invests in businesses he can understand, looks for clear, simple business models and consistent demand, avoids businesses that are too complex or hard to predict. He also looks for companies like Coca-Cola, for example, that have competitive advantage or economic moat, if you will. Buffett looks for companies that are hard to beat. They have a strong brand, customers trust the brand and keep coming back, loyal customers, people prefer the product and don't want to switch, low costs, the company can make and sell products cheaper than others, unique advantage, something competitors can't easily copy or replicate, keep winning for years. The business stays strong and keeps growing over the long term. Key takeaway: buy companies that will be still leaders in 10 to 20 years from now. We want to own wonderful companies. Warren Buffett. Also looks for excellent management. Seek honest, capable, and rational leaders. Management should think like owners, not empire builders. A great company with integrity is critical for long-term success. Financial strength. What does Buffett look for in a balance sheet? Why he looks here. A strong balance sheet shows a company can handle problems, invest in growth, and keep compounding value for years. Low debt. Little to no long-term debt. Why? Less risk and more flexibility. Strong interest coverage. The company makes more money than it pays in interest. Why? It can easily pay interest and even in bad times. ROE, return on equity. ROE is consistently above 15 to 20%. Why? Shows the business earns well on shareholder money. Consistent equity growth. Shareholders' equity grows steadily over time. Why? Retained earnings are building value. Large cash position. Plenty of cash or short-term investment. Why? Provides a cushion and opportunities. Good liabilities versus assets. Current assets should be greater than current liabilities. Why? Can meet short-term obligations easily. Buffett wants financially strong companies that can survive tough times and keep growing value over the long run. He also looks for ROE, look deeper dive for the ROE, high return on equity. Buffett looks for businesses that generate consistently high returns on shareholder equity. For example, here on Apple, why it matters, shows management efficiency, indicates competitive advantage, creates long-term compounding, leads to higher intrinsic value. Buffett wants to see ROE consistently over 15% for many years. Consistent earnings growth. Buffett loves businesses with long track records of steady, predictable earnings growth. Long history, over 10 years of earnings growth, recession resilience, low earnings volatility, strong demand for products and services.